pleasure to meet everyone. My name is Rich Mazzola. My background by trade is a CPA. I've been in and around public accounting firms for most of my career. Early on, I was spending most of it in transaction advisory services. So mature companies trying to sell or buy, go out, poke holes, see where the warts are, and then publish a report, quality of earnings to do that, work with private equity firms to do that. Landed in Oklahoma City and Texas. I'm born and bred in Cleveland, Ohio, but lived in Oklahoma and Texas for quite a while, for about 3 years. And while I was there was a small segment of downtown Oklahoma City called Strawberry Fields. And in Strawberry Fields, it was their attempt at Silicon Valley, and they'd passed some state legislation that allowed, if you bought tech equipment in the state of Oklahoma and you left it there, think server farms, big dollars, you would get all that equipment sales tax free. So there was a lot of money coming in, investor money, a lot of entrepreneurs coming in, especially on the tech side. So fell in love with the venture-backed space there, did a lot of pro bono work out of an accelerator program called Starspace 46. Came back to Cleveland, Ohio with my lovely wife. Ended up leaving, I'll call it my brief sabbatical from public accounting, and joined up with a smart tech startup here in Ohio during their Series A funding round. So spent about 13 months with them, helping them clean up everything in their accounting and finance function, helping get through a couple term sheets, and really realized in that segment,
as a full-time employee or as a consultant?
I was a full-timer, yeah, at that time. I was director of finance for that company called Drips. They were a telemarketing AI engine for text messaging platforms, so passive marketing efforts towards consumers.
Okay.
And realized at that point in time, from seed to Series A, there's really not a lot of work for CFOs, director of finance folks to grasp or handle there. But these companies need that help. And so I took that concept, that thesis, brought Drips back as my first client as a fractional CFO, and launched a practice around, again, fractionalizing the CFO position. And again, half of my portfolio is in the technology space, which would include blockchain, app development. And then the other side is medical device, which I would include health tech, so life sciences more or less. And so what we do there is, what I would say my sweet spot or my perfect client is on the tech side, it's a post-revenue, closing Series A or growth funding there, SaaS-based companies. On the medical device side, which is what we're all here for, I would say it's pre-revenue, pre-510K submission, getting involved in helping them lay the foundation work for the commercialization stage as they approach it. And that can be anywhere from 5 to 20 hours a month. And then sometimes I'm sitting there as a finance consultant, sometimes I'm sitting there as their CFO. So it just depends. But Duane had interviewed me in November of 2020, said, hey, what's this fractional CFO stuff about? So we had a great conversation on his new podcast called Project MedTech. And then from that, we conceptualized Project MedTech Consulting, which is, again, a one-stop shop for entrepreneurs in the medical device space to come to us again at that seed to Series A or even pre-seed stage. And we have corporate strategy, financial strategy, brand development, product roadmap and development, investment strategy, all of those components under one roof to help us kind of launch these startups and get them to that Series A stage, and then take a step back and sit there as an advisor or on their board or advisory board to help them continue moving that along. And our mission is really to accelerate medical technology getting to the market and in the hands of consumers and patient care folks.
Yeah. So Rich does a lot of the cheat or the, I guess, financial strategy work for us and for our clients. And so we took that and then we coupled that with the MedTech Money series we host, right? So we host a MedTech Money podcast where we interview, I guess Giovanni does, who's another partner of Project MedTech. He interviews entrepreneurs and investors on MedTech, everything from pre-seed, seed through going public, right? And what they look for and how they've raised money. And so what we learned was that no story is the same from raising capital. We've heard, 50 different stories from entrepreneurs. And then so we tried to take some of those and circle some similarities in what we've seen. And then the one thing that is consistent is the feedback we get from investors, right? And so Rich and I kind of met and said, hey, can we take some of these ideas we've been hearing from investors and entrepreneurs, and then what Rich knows from the technical side, and merge some of those things? And that's kind of what we're here to talk about today. So yesterday on our 4 hours in the car together, we came up with different topics that we thought were important before you go out and raise your next round. Some high level and some more in the weeds. And so we'll kind of just bounce back and forth between them. But the first one that we came up with was kind of level setting entrepreneurs to investors. Because I think sometimes we put investors on a pedestal, right? And think, hey, any money is good money. We go out and we raise money and it's about shots on goal. We hear that phrase a lot. And I think we kind of want to debunk that a little bit, right? So there's good money, there's neutral money, and there's bad money. And I think entrepreneurs have a hard time deciphering that. good money is going to be that person that comes in, they invest, but they also bring something to the table. They're bringing a network, they're bringing some type of expertise. They're filling some gap for you. Neutral money is someone who's going to come in, invest, maybe they're pretty passive. They don't bring anything to the table, but they're certainly not going to hurt the mission of the company. And then there's bad money. And I think bad money, I'm not sure, maybe Rich has some examples of where that probably hurts in a pre-seed seed round. Bad money creeps in Series A big time. And so when you start raising from some of those venture capital groups or institutional investors, I think interviewing them as much as they're interviewing you is really important to figure out where are they in the fund. Interview some of the companies they've invested in. How have they acted? Because they're probably taking a board seat. So how have they acted on the board? Are they, do they align with your mission? Is your mission, they might be looking for a 2x, a 3x return, something quick because it's the end of the fund or beginning of the fund. And now, they have some voting power and they want you to exit your company the first offer you get, right? And that could be a problem because maybe you want to take it a little bit further. So that was like our first major point. Go ahead, Rich.
Just a side note with the bad money too, and that would also include, I call it debt equity. It's when folks are not involved in the organization, they're not providing value along the way. They're just kind of sitting on the cap table. Maybe they're on the board. Maybe they're barking about your lack of budgets or missed deadlines on your Gantt chart. You want people that reinforce your mission, that help you get through hurdles and help you overcome that. And that's where we say is good equity. And that's a lot of the times what I've seen is when missed deadlines are happening, especially 510K submissions or clearance dates, which are out of your control sometimes, especially around the development stage or the FDA taking their time. When those things happen, sometimes in the contract, if you don't have a good attorney, there might be issues with control. There might be issues, and that's really where bad equity becomes a problem for everybody.
Yeah.
Your audio broke it just for a moment. Did you call it dead money?
Debt equity.
Oh, debt money.
Equity.
Oh, okay.
No, sorry, DEAD equity. So debt equity, meaning that it's just sitting there and it's
yes.
up your
Okay,
cap table.
that's what I thought you said. I was unclear. I think that's interesting, and I understand it completely. It's almost intuitive that you let someone buy their way into giving an opinion, and it could be very distracting. And they could say, "Look, I just gave you this much money. You're going to listen to me," and it's like, "Yeah, but you don't even know what you're talking about."
Yeah.
Joe, it's also it becomes a big problem around the exit stage too, because now we're talking about somebody that we have a good deal, everybody's on board, and that one person that's sitting on your board is causing conflict because they didn't like the deal, or maybe their opinion was different on the approach of the exit. And so when you have different opinions,
have you seen companies fail because there were bad board members, if you will?
So I wouldn't say it's fail. The old adage is there's three types of startups in movie genres. And the joke is there's the rom-com where at the end everybody wins, right? Everybody's happy and everybody wins. There's the drama where the people that you hope would win, and the people that lose. And then there's the horror film where everybody just dies, right? And I don't think they fall into the horror film, but they definitely fall in that drama one where there's a little bit of tension. And maybe the folks that pull away are the ones you've rooted for or not, but it just depends. Mm-hmm.
Yeah. And I think the other major point we wanted to touch on in this part was who you raise money from and why. I think that's the other thing we see people miss, maybe in the seed round specifically. We'll hear people say, "Oh, we're going to do a $750,000 seed round," and maybe they go after some institutional investors, but that carries that's maybe a little different than going after angels or high net worth individuals. And do you want control of your company? Do you want to be the CEO of your company? And I think we talk about this later on. We're going to talk about board formation and too early versus too late, and who's on it, and how that affects maybe your aspirations as an entrepreneur, right? Because we've certainly seen that once you start getting money in there could be a hostile takeover. You could be voted out as CEO. Do you want to be that person in the commercialization? So we'll kind of get to that. But I think the next one we really wanted to cover, and it's technical, so Rich, I'll flip it over to you, but just types of investments. I think we get this a lot: safes, notes, equity, etc. Maybe just cover a little bit of that.
And before you do, I want to give you a shout out. I had no idea how prolific you were. You've already had 77 episodes of your finance.
Oh, yeah.
MedTech Money.
We've had 77 of MedTech Money and 96 of Project MedTech. So we're encroaching on 100 for Project MedTech in general. And then MedTech money will be at 100 probably by the end of the year.
You conceived Project MedTech? Is this your brainchild, Duane?
Yeah. I found it in 2020, just as the podcast. And then I met one of my partners who we formulated the idea of the media company a little bit more. And then Rich and I really sat down and formulated the consulting company, and then kind of conglomerate, put them together. And now they run.
How many are you now? I know Giovanni personally.
Well,
Now
we're
I
a
know
team.
Rich and his landscaping in his house.
Yeah. We're a team of 7, and the 8th will be
Tim Blair, right?
Tim Blair. Yep. So there's Tim, Sean McGibbon, Rich, myself, Aaron, and then we'll have another announcement in a couple weeks, and maybe even another one after that. So yeah, we're quickly growing. But yeah,
I'd like the chance to meet Aaron and Sean if they're not busy. Throw them on the call.
Sean, I invited. He couldn't make it. He's a fantastic resource. He ran 3 hospital systems here in Ohio for the broad part of his career, and now he's a part of a startup, and he supports our companies as well. He's got a really good insight into how hospital systems evaluate technology, and not from like the clinician physician side, but the revenue cycle, the CEO of a hospital, and so he adds a lot of value to our clients for sure.
And Aaron
is heavy on the operations and supply chain logistics.
I know a guy like that.
Aaron's an engineer by trade.
Yeah.
And so we were on a call with a client yesterday, and we were talking about the commercialization stage of switching from prototype tooling to full scale up production tooling, and what that means and the timeline for that. And Aaron was getting involved from a technical side between plastic molding and steel molding, and how the components of the prototype, and it was out of my league, it was over my head, but what it meant to the client was immense, because they understood that they were an engineer as well. So he brings that real technical side of the nuance of what you want to do at that stage.
Thank you. Okay, so you were about to talk about financial instruments.
Oh yes, so we, this is very high level, and obviously there's interesting things or creative ways to do financing that we've heard about, but these are the 3 major categories that we typically see, and those are safe notes that were invented by the Y Combinator out west.
I'm sorry,
the spin-off of what was called
I didn't understand the word you said. Statesmith?
Y Combinator. Safe. So SAFE.
Oh, safe. Okay.
Yep. Sorry, my audio might be a little choppy. I apologize. So safe notes, again, were the invention of the Y Combinator, which was an accelerator group out west. It's where Stripe was kind of conceptualized and launched from. And what a safe note is it's a spin-off of a convertible note. And I'll jump to convertible note really quick and then go back to safe, and you'll understand why at the end. A convertible note is a debt instrument. It is a promise, it's a loan to buy or convert to future equity. What a safe note typically looks like is, we'll call it $100,000 in debt. There's an interest rate tied to that. The interest rate accrues on a 365-day cycle. It doesn't compound, meaning you have daily interest. That interest is accrued on your balance sheet. So it sits as debt, it sits with the accrued interest. And at the qualified financing event, which is usually defined by the term of a certain amount raised of preferred equity, and that would be typically a Series A, that convertible note converts into equity. The conversion rate of that equity is either at what's called a value cap limit. So, let's just say I bought in with a value cap limit of 10 million, and my pre-money valuation of my Series A was 15. That means I get my shares at the $10 million valuation, which means I get more shares than if I converted it at the 15, right? Which is the principal plus the interest that accrued up to that date. The other side of that factor is a 20% or some sort of discount rate, meaning if I sold my shares at Series A for $1, I can get them at 80 cents because I was early and as a convertible note holder. Mm-hmm. Now, the typical arrangement is one or the other, not both. And a typical arrangement would also say whichever option provides me the higher number of shares, meaning it's not a choice, it's a default. So if you don't have a qualified financing event and that debt sits there and it comes to term, you have to pay that back. It's debt with private investors. Typically what I see when term dates are coming due, you go to the convertible note holders and say, hey, I need more time. I'm actually going to go raise a bridge round right now to get us to the next Series A. And at that point, you can extend the terms and negotiate or renegotiate those contract terms at a later date. So that's what a convertible note is. A safe note, again, was an invention by the Y Combinator to not have so much legal jargon, not have so much debt on the balance sheet for early stage startups. And they said, look, I want it to look like a convertible note, but it's not debt and it's not equity. It's just a promise to buy future equity. And so think of the convertible note as the same terms: value, cap limit, discount rate, qualified financing event term, but there's no payback. And maybe or maybe not, there is interest that accrues as well. And so the concept of that is that we can go ahead and shift or push out equity or cash a lot faster to these pre-seed, seed startups. And then we won't have these legal barriers, these dissolution issues that are created from convertible notes. And it was just a way to move capital faster. And so we see a lot of those flying around too. The big risk with safe notes, and especially at the pre-seed stage that I see, is that the value cap is extremely low. And you don't necessarily have, yes, this is the Y Combinator's website. And so if you look,
I've never heard of them before.
If you go to the resources tab at the top, there's, the safe's right there, actually, right next to it. They have their whole term sheet and documents. You can download the latest one they've written up. It's a really great website, and they have a lot of good resources on that website too, in terms of what the hell is a safe? How do I even go through this? What does that look like on a cap table dilution scenario?
I'd never heard of them before. That means little, but I see it was founded in 2005. You're talking about these concepts as though they were widely known and available. Is that true? Is this a proprietary investment vehicle to them, or is it now replicated and you can get that anywhere? I'm a little lost.
Yeah, no, I would say it was very prominent on the West and East Coast, and now it's kind of trickling its way into the Midwest, mainly because I think coastal investors are coming in to get better rates on startups. I'm seeing them more predominantly at the pre-seed stage. Seed is typically convertible notes. But yes, they are. It's not proprietary. Anybody can write up a safe note term sheet and sign one. You can download them here. They're open to use.
That's exactly what happens.
Mm-hmm.
I think these are all
So yeah, and so the major concern with safes is the low cap rate. And to me, it's a lot of entrepreneurs, they sit there and say, well, I got my money. It's really fast. It's not dead. I don't owe it back. This is awesome. And the cap threshold's really low. And I started to hear conversations about, and I know one particular investment group that uses safes that have very low cap rate. The concern is that once you get to the seed or Series A stage and you start doing preferred financing, the conversion of the safe note holders, in some cases, they might hold the same percentage of the company as the Series A holders. And that drives a lot of VCs a little bit crazy because they're getting such a good deal. And so there's a negotiation on that value cap. And I think that's what's very important to pay attention to when you negotiate this with the pre-seed seed investors. And that's the only pause I see with safe notes. Otherwise, I love them. They're fantastic. So what I do for a lot of clients, especially when they're approaching their Series A, is we've got to go through a cap table dilution scenario that says, here's my safe note. Here's what I know it's going to convert at based on this pre-money valuation. Here's my convertible debt based on the accrued interest, and here's how that's going to convert. And here's my Series A financing, and that's how that's going to convert. Oh, and by the way, because we're going into the commercialization stage and I got to hire a head of sales and a head of products and all this other stuff, I got to start an equity pool too. And so you start seeing your ownership really trickle away quickly between those couple stages.
I can see here that there are some marquee brands that I guess have used this particular accelerator. Sue, you are familiar with them. Have you interacted with them at all?
Yeah, I applied for it, and I think I would have gotten it. It's usually first come, first serve, and I waited till the very last day to apply, so I didn't get it. And then I think I'm too far ahead to apply for it anymore. I'm not really interested in safes at this time because I've already got most of my pre-Series A money. So I'm kind of in that middle point where I need a bridge round and a Series A, and I've got the bridge round pretty much secured, but now I have to decide how much of my company am I going to give away, and that kind of scares me and gives me shingles.
They invest $500,000 in every company, $125,000 for 7% of your company, $375 on an uncapped safe with a most favored nation provision, which Rich will now explain.
I haven't had one of those, unfortunately, or fortunately, but I believe the term most favored nation is the best terms you can get, in theory. I'd have to do more investigating on it to give you a little more detail, but. So those are the two major ones you see at these early stages. The one that I tend to tell startups to stay away from is straight equity, meaning I'm going to price myself at an early stage and give myself a hard valuation line. The reason I say it's not really advantageous to do that is because you don't want to put yourself in a position of a down round going into your Series A. The Series A is a very exciting time. It's growth capital. It's my fire has been lit, and now I'm pouring gasoline on that fire. And that's what that growth capital is going to do for me. Doing straight equity in the early stages puts a stake in the ground on valuation, which means you need to show a leap in valuation each time you're going to raise based on these milestones that you've achieved or the work that you've done. Mm-hmm. And so what happens if you do that early is maybe you didn't make progress, maybe you didn't hit your sales numbers you thought you were going to hit because you were going after the hospital systems, and the hospital systems were 6 months, you thought, but it's actually 12 months now, and these things happen. But then when you go to your Series A round and you haven't hit these milestones, they're like, well, you said you were 5 million at pre-money at the last round, and now you're saying you're 15? Why? How? That doesn't make sense, and it doesn't to investors, and that's what scares them away. And so I'm very cautious to raise early stage equity, just straight equity at those points. But when you have something that's real with revenue, at that point we can get some people to the table and talk about some jumps in valuation.
You started us, and of course I interrupted many times, forgive me, that there are 3 types of vehicles. One you said was safe. Second was, as I recall, convertible, right? And then the third is straight equity, or?
Straight equity, yep. Now, obviously, there's other instruments that exist out there. There's other groups, like I know a group in Cleveland called Eagle Bend Capital. They do very interesting financing too. It's, AR factoring or inventory or, those types of things. Those exist. But these are just the equity vehicles for capital financing. Obviously, we're in the life science space. So SBIR, NIH, right, TVSV, or TVSF grants, government grants, they're non-dilutive. Those are fantastic. So if you can find those and they fit what your product doing or what your mission is, those are always advantageous to go after. There's a little bit of internal compliance accounting you have to do, reporting. But in reality, if you can, and this is a great conversation we had yesterday, Duane, with a client, was they have a NIH grant that they've applied for phase 2, and it's for, we'll call it $2 million, and they need to approach their seed round and do a raise of 4. And so the question was, do we plan to raise 4 million? Well, what happens if we get this NIH grant phase 2? Do we raise the 4 and now we have 6, or do we overcapitalize or undercapitalize? And I said, well, one of the great approaches with convertible notes and rounds are you open the round, but you just don't, you make it a rolling financing round, because we're going to find out in October if we get the grant and we're not going to get the check until January. Well, at that point, go ahead and open the round, raise you up to 2 million, and then pause. Just put the brakes on. You can still keep your investor pipeline warm, but then find out if you get the grant. If you get the grant, don't raise any more capital, because we're at a point where we know the grant's going to come and we have enough capital to get us there. Or if it doesn't come, God forbid, now we can go ahead and raise the rest. But the conference Duane and I were at yesterday with some venture capitalists, the conversation was you should be raising 24 months of capital to make sure, based on your burn rate today. And the reason for that is the recession. And you're going to see investors starting to get really picky about companies and how much they're going to invest and when they're going to invest. So as interest rates continue to climb by the government bank, we're going to have, I think, some shrinkage of how much is going to be pushed out there and capitalized, or how liberal they are with the push of the capital. So my point there is, if you're actively raising, I would build, and I always tell companies, put a 20% buffer in their budget to accommodate maybe some delays or increased costs. I'm telling my clients now to do 40%.
Yeah.
So you want to share with the group what you just typed?
There's
I'm sorry?
I was asking Sue to share aloud what she wrote in the chat.
Yeah, AFWorks is a non-dilutive funding platform that will invest whatever you invest. They'll match whatever the investors match. We're looking for phase 2 grants right now, and that's kind of where it's an SBI or NIH phase 2 type grant, I believe.
Richard, Duane, I suspect, I know you have no slides. That's great. Great conversation. I don't know how many things you want to hit, but one thing I would like to do is there are at least 4 or 5 folks on the phone who are fundraising now or may be soon, and I'd like to give them a chance to ask a direct question.
Yeah. Could we give one more point? And then the rest of the points we'll litter in as we answer questions, but that sounds great. I think the one thing Rich and I, the 3 were like, the third one was, at all the investors, the most important thing, and then this is how you could structure your pitch deck, your pitch to them, it's team and problem, and then products down here. And that's consistent with we've talked to one investor who said they care the most about the product because they can replace the team. And that was like a little cynical. Every other person, if they're not, they have to be bought into the team first. And then they have to be, the problem has to be there. The product matters, but it's like, it's down here. And that's been confirmed on every podcast we've done. So I think, as you're thinking about that in your pitch deck, make sure you're highlighting those things and highlighting those things more, right? I mean, we see that a lot where people, talk about the company, they talk about the problem, and then they're right into their product and how cool it is and all the competitors. And if they're not bought into that problem, you're just not checking the boxes. So I think getting that out there was something we wanted to get across as well.
Yeah, and I saw a question come up, what about traction? And I think to that comment, it's at an early stage, it's not as important. Maybe it's a track record of what you've done in the past in terms of your prior startups, if you have them. Traction really matters, I think, more importantly around the Series A level, because that's where you're showing the revenue and that's where you're showing customers are interested and there's a market fit. But I would say at the early stage, I'll give you an example. There's a company that said there's not enough healthy cookie options in the supermarket, and they decided they were going to make a healthy cookie. They go to the supermarkets, they've invented this thing, they want to get it in there. The logistics of trying to ship a healthy cookie option to all these different grocery chains around the country was impossible. There were only 2 providers that did it. And so what they said was that's a problem. And so the team pivoted away from making healthy cookies, and they made a logistics company for shipping healthy products to grocery chains around the country. And so that was their startup. So it was the team that their investors liked, and it was the problem they saw that they were fixing. Maybe it wasn't they liked the cookie idea, maybe they liked the idea of getting healthy options in the chain, but they realized there was a logistics problem along the way, and they pivoted away from just making cookies to making the logistics better. And so that's where we see team, problem, and then product. I think a lot of VC firms will say it's always team over product. We like the problem because if you know and if you've identified the problem, the team being first will always go after it and fix it.
Yeah. So Joe, I'll turn it over to you. The other thing real quick, because I think this will answer a lot of people's questions. Networking, warm introductions, they are ridiculously important when raising capital. And we've kind of seen that just from some of the connections we've made where they're coming to us. We've had a couple of the startups we're working with who have reached out to the same investors we know. They didn't get a response. And then when we made a warm introduction, they got a phone call, right? So I think that's really important. And then once you get one, FOMO is a
Real
big
thing.
thing. Oh yeah, 100%. And even like for us in Cleveland, it's probably different, but there's only so much money in Cleveland in terms of an investor standpoint. If one of those investors invest, I guarantee somewhere on that balance sheet, the other 3 major ones are showing up on there, right? And that works nationwide as well to a certain extent. So just be aware of that.
Mm-hmm. Yeah, that's basically brand equity. I mean, it's social proof. Somebody trusted it. It's by association.
Yep.
So as I mentioned, there are at least maybe a half dozen folks on the call who are in various stages of funding their companies. Do any of you want to just take yourself off mute and ask a question? Or
I have a question. So right now we're have a bridge round funding, and I have an investor that just wants equity, so that will be for my Series A. We're preparing for FDA, slated for December of 2022. So hopefully we'll be on the market by April or Q2 of next year. When do I bring him in for that Series A investment? We are valuated at, I think, $7.2 million right now. And right now, everything is through convertible notes. So my question is, do I take the equity, and how much do I give up of my company right now?
So a couple of clarifying questions. So you have convertible notes to date. I'm sure. What's the value cap of those convertible notes?
There's no cap.
No cap. Okay. So there's the discount. Then is the only option within there. Yeah. Okay.
Right now, they're at a 20% discount at 6% interest.
Okay. And this bridge round has been opened. Has it been opened as a convertible note?
Yeah, and that's I think the interest is 6% still, but at 10% discount.
Yeah, I guess they're willing to put in money, but they're only willing to put it at their terms. And they're not, is it going to be like a lead investor, or is it somebody that's just kind of friends and family or sidecar?
Friends and family, but a large investment.
Okay. So in that regard, bringing them on probably wouldn't make sense until you have a lead investor, because you don't want to be giving them isolated terms compared to a potential institutional investor. You probably want to wait until there's somebody leading. Okay. So I would then follow along with those same terms in that regard, but I would only do it at the stage in which your valuation is ready for you. So I'm going to zoom out of just financing now and talk about the operations of the company. And the comment here is you're in FDA submission mode, right? You're getting the write-up done, you're getting all the testing done, you're going to submit it all to the FDA. There's an argument to be made that your valuation automatically jumps as soon as you submit, because you're in the pipeline, you're working through the kinks with the FDA, you're going to do they're going to ask questions, you're going to give feedback. So to raise the money now doesn't make much sense, especially if you're so close to an FDA submission. Now, if you need the money to keep the lights on, that's a different situation. But if you're able to kind of do the bridge, it's a convertible note and get you there, I would say let's wait, because then the valuation bump at the 510K submission, if the FDA is speedy along and they love it and they're moving really fast, maybe there's an argument to be made to wait until the clearance happens, because then there's even a bigger valuation jump at that point. So to protect your interest and to protect your prior shareholder interests, those are on the cap table already, it might make sense to wait. But again, with the recession, with all these different assumptions going on, it just depends on your position today and kind of where your trajectory is.
Yeah. And I think, Rich, to tack onto that too, the event we were at was the Healthcare Capital Markets Innovation Summit. It was a lot of larger private equity groups, right? So it's not like this was the venture capital groups that are in a Series A. However, we have heard it from some of them as well. The same thing of, the advice of raising 24 months of runway. So I don't want to be too negative, but yeah.
There was actually, that's a good point. There was a comment made yesterday that, from a VC, and he's like, well, I had companies that raised 24 months of capital back when the pandemic hit. I had companies that raised 12 months worth of capital. And I had companies that raised 6 months worth of capital. And if I told you at that point in time, I thought the 6 month people were idiots and I thought the 24 months were smart. But after we fast forward to today, the 6 months were the smarter people, because they took less equity and their valuations were higher. So it's a matter of perspective. We don't know what the future is going to look like, but there's a lot of doom and gloom out there, especially when rates are on the rise.
Thank you. Very, very good advice.
Melissa?
So I have two questions. Just without regarding valuation, what is the best cap rate you've ever come across?
In terms of like the value cap in a note?
Correct.
I've seen aggressive ones. I wouldn't say it's the best, but I've seen aggressive ones, which means we raised a pre-seed round at a safe note of a $15 million cap. And then they're planning to raise their seed round at a $30 million cap. And so, when I have clients tell me that, and this is a technology company, so those big markups are different because it's a SaaS and enterprise type model. But when they tell me that, and I say, okay, that's great, let's look at your projections now, and I run their revenue multiple against that value, and you're talking about a 25x at the seed round. Those are big aggressive things to do, but there's massive upside. And so if investors want to get in at that earlier stage, it might convince them, but at the same time, you're talking about massive leaps in value. And so you're putting yourself a little bit at risk. Everything's always disclaimed, I'd imagine, in pitch decks. Hey, we don't know what the future is going to hold. These are just projections or with assumptions. But at the same regard, if you're showing those massive leaps and then you're over promising and under delivering, I say those are aggressive. There's a little bit of realistic nature you need to have, and there's VCs will read right through that, I'd imagine, especially if you're talking to sophisticated investors. So starting with a higher cap at 10 to 15, I think is fine. I don't like anything below 10 million in the pre-seed cap, because it's depending on what's going on, obviously. But showing hey, I'm going to go 15 cap to 30 cap, there needs to be a massive reason why you're making that big leap in valuation.
And then, so with regards to a product pipeline, like let's say we have one product and we need 5 million just to get that across the board, instrumentation, FDA approval, hiring a team, so on and so forth. But yet for the product portfolio that is going to launch, let's say we need to have 10 million. How would you handle that? Do investors look from the perspective of we want to just get this one product, or is it more valuable from an investor standpoint about the portfolio prospect?
The portfolio is something so I'd imagine most investors want to see 3 to 5 year projection models. And I think from whatever your main product is, whatever's going to make you the most money, or maybe it's the intro product to get you into the market, that's what they're currently looking at. But it's important to show as part of the pitch deck, here's the grand empire we're going to build, and here's the products that we want to build along with that. I think there's a strategy in showing which products are next. And those are maybe the low cost but expansive market. There's always that chart that says it's what our current markets we're in, what are our current customers, what markets aren't we in with current customers, right? And so you're looking at that analysis to say, and I'll give you an example. One of my clients said, hey, I'm going to make a product for humans. I'm going to go through the 510K. I'm thinking about the CE mark, but I'm just going to go through 510K right now. But we're going to make a couple of minor tweaks to the product. So now it opens up the animal surgery sector. And so you're making a small tweak to your already primary product, which is, I would argue, is low cost, but it opens up another market that we can sell into. And so as an investor, and I see what you're thinking about and how you're going to, the ancillary markets around your primary product. If we're talking about widget A versus widget B and they're completely different, that's to me like two companies I'd invest in, and you need a lot more capital to do that option B later. And so I would think about the strategy of which products you're going to advertise first before you push for those larger expansion projects.
And Alyssa, I think too, the other thing is it depends on who you're raising from again, right? Because I think most investors in the med tech space are comfortable with single product companies, right? Hey, you're going to make a single product. We're going to get our return on investment when you exit, right? And so, generally, I think that's pretty traditional, but there are some investors, and we've talked to them, that are looking for, companies with a little bit of a portfolio as well. And beyond just, hey, this is our first indication for use, this is our second, but maybe this is, like Rich said, an actual iteration of this, right? And so I think that's there. It just depends what investor you're talking to, and that's something you can figure out in your due diligence process.
Yeah, and there's really two models when you run a life sciences company, especially with a product. It's what I call poke the bear model, and then the enterprise model. And the enterprise model is, here's my massive empire I'm going to build, like you said, here's all these products, here's the markets, I'm going to do an IPO in 5 years, all this stuff, right? And that means a lot more capital needs to be raised. And then we have the poke the bear model, which is, I get it to the 510K, I get some clearance, and I get some sales, just enough to bother Stryker, who then is going to acquire me, right? Or something like that, some strategic. And that's that poke the bear model. And so it just depends on which trajectory you're going. And there's two different strategies with both of those.
Now, let me say, I apologize, I have one more question now. Let's say that like television companies, like Toshiba, they'll come out with their own product, or smaller companies, they'll come out with their own product, commercialize it over the course of like 6 months to a year, and then they'll license the IP out once they've gotten a little bit of their own market. How do investors feel about that model in the med tech space?
Like a royalty model?
Yeah, like private label or royalty.
I think it depends if you go contract manufacturer versus building a big warehouse or manufacturing facility to do it yourself. Investors like that, but the exit potential is more difficult. So if they're quick cash, quick exit, it's not as advantageous for them. But if they like the cash flow scenario, they like the idea of getting them some dividends later down the line and then selling it. Okay, that's maybe or maybe they have a portfolio company that can tie into it. I can see that being an advantage to them. I think there's investors that really like the poke the bear. There's investors that are aggressive that like the enterprise model and the licensing model, like you just described. I think there's another subset of investors that would be attractive to that. You just need to find them, because you don't want to find somebody that's poke the bear and wants their money out and you're doing a licensing deal later.
Rich, can I answer that also? So there's a Grail was such a company. Grail essentially came out of Illumina, and Google invested in that, and then ultimately Illumina bought it out. So I think Illumina invested about $500 million, and Google invested $500 million, and then Illumina bought it out for about $8 billion. So, Rich, I have a question. How do you go about doing the valuation? I mean, at different stages, do you follow the VC model, or do you do a net present valuation calculation? How do you go about doing the valuation? There's a couple of investors I'm talking to right now are asking me that, what the valuation is. And I've got a cap, but to show them at least that, hey, you're getting a better deal, because if I do the net present valuation calculation or the VC model, it's going to be different, right?
So Sanjeev, Rich texted me while you were talking, and I think he lost audio, but I wonder if he's back now.
I just got back. Sorry about that, Sandeep.
No problem.
Sanjeev, you might need to re-ask that.
Yeah, so I was wondering, how do you go about doing the valuation calculation, right? Because there are multiple models out there. There's the DCF method, there's the way the VCs calculate, right? That this is the return on investment they want, etc. And then there's the net present valuation calculations. I'm talking to a couple of investors right now, and I've created a cap for my company right now, right? A valuation cap. But it would be great to show them what the valuation of the company really is, right? Versus what they're getting, because they're getting a better deal. Any thoughts?
Yeah. So to do that, it's difficult, right? Because the joke is every startup's worth 2 million at the beginning, right? And it's hard to say based on this is what I typically do, and I'll start there, which is I take an enterprise model that's maybe 5 to 10 year projections, and you discount the hell out of it. Meaning you say I'm going to make 132 million in 1 year, in year 7, and you discount that back, and you do the discounted cash flow model. So then, okay, if that's the projections and the value in the future based on these comp points, data points, meaning here's the value of other companies at those stages at that size, and you discount it back to what it is today. That's sometimes how you can support that position that you're in. Alternatively, if you're investing heavily in IP, sometimes you could attribute value to that, especially if there's licensing deals like we talked about before. So it really just depends. The investor typically has a model they like, and I just say, well, what do you want to see? And I'll build it for you. We have the projections. I'll just model it into your value analysis.
Yeah. Since Sanjeev, we could probably do some of that in the coming months with you.
And Rich, while you were speaking, I found you on LinkedIn. I shared your link with the group, and
Oh, great.
I see that you're part of a 124 employee group called Peas. I didn't realize that when perhaps you said it and I missed it.
That's okay. So yeah.
What is the expertise of Peas overall, and how much of your time, you're full time there, so how do people have you on the side as a consultant, or they typically work with you through Peas? That's PEAS.
Yeah, so it's a joint effort. Yeah, it's Please without the L is the way I describe it. But yeah, that's a CPA firm here in Ohio. We're about 120 person firm, regional based, but half of our clients are in the West and East Coasts. The big market that firm has been in is the nursing home and healthcare space on the tax side. So that's the specialty of the firm. I have a practice that runs out of that. Project MedTech is effectively another piece of that where we work together on clients collectively.
Let's see. Shreya, you had a question. Is she still here?
I'm here. I'm still here. Yes. First of all, fantastic information. I mean, great answers, and I learned so much today. Thank you for that. We are self-funded, and we are about to we prepare for our FDA for 510K clearance. And I was wondering, I could go bootstrapped for a little bit longer, and listen to you now. I think that would be the wise decision after at least I got the FDA halfway through. And I have also resellers already. They would bring a revenue in that very instantly. So I think I should wait. What would be your advice on how I should set myself up?
Well, the other thing you need to take into account is the global economy as well. And so, depending on your risk aversion, So it's easier to raise capital once you submit. It's even easier to raise capital once you have clearance. The valuations are higher at those points. If you were to potentially do a convertible note or a SAFE at this stage, that might make sense with a higher value cap, right? So that kind of bridges or kicks the value can down the road. And so it might be easier to do that today if you need the money, especially with the economy the way it is. When it comes to resellers, these are distributor agreements or active reseller agreements where they have your kind of product in the catalog.
That active reseller agreements.
Okay. So I'll let our business development guy handle that question or segment of it. So with, I guess, Duane, from your perspective on the valuation side, by having resellers, maybe with or without traction, is it important to wait until there's more established traction with the resellers and clearance, or is it something where is it even a value at this stage, especially without the clearance? I guess is the question.
Yeah, I think you want traction. That's going to bring you value. Resellers being in with a distributor doesn't mean much. Unless you're generating revenue from it. I mean, we're doing this right now actively with 3 or 4 of our clients who are in this position of we're trying to figure out the commercialization strategy and what that looks like and the ins and outs of that. And so, resellers are great, but they're not your employees. They're not, maybe they might not be incentivized to sell your product. They might not be the best margin, right? So it's kind of hard. You're beholden to those people, right? Go ahead, you're gonna say something.
Yes, so since you don't know my product, it is resellers, they actively sell and get a commission based on, but they use it also. It's chiropractors and they will use my product. So,
yeah.
And they will also get a certification through us to use the product.
Mm-hmm.
So that's two-sided.
Yeah. I would say, that's a great inroad, right? We have a couple products that are similar to this that sell to physicians and rely on them to resell to their patients and that kind of thing. And there's a little commission, but I would say, what we're seeing, at least what we kind of support is, going out and getting a couple W-2 employees. And that's what I would do with your first round, or what it sounds like is going to be your first round. So maybe waiting until you have clearance and those people should be, I wouldn't advertise that as like, oh, we're commercializing. I would advertise that as almost like we're testing the market. We're seeing what works. We're trying to figure that out because investors are also pretty keen on that as well and understand that. But I don't know, that's kind of where we're at. We've done the whole thing where the Smith and Nephews of the world want to come in and exclusive deal and all of this stuff. And that's great, but just don't forget, you're now beholden to them. Mm-hmm. And so I don't know, it's a tough question. We'd have to look at it more, but we like to keep it in our own hands and be able to control, we can control. And sometimes that stuff, it gets a little out of our hands.
Trey, I might add.
I apologize.
Thank you.
Just one, I apologize. I have a hard stop here at 12, so I can take one more question before I jump in. Then Duane, if you have time, you can stay on.
Yeah. Yep. Yeah. Looks like you're good to go, Rich.
Mm-hmm. Yeah, we're done with you now. No, that was
It was
great.
a pleasure meeting everyone. Yeah.
On LinkedIn, please welcome me to your network. You're welcome to join us whenever you can.
All right. Yeah. Feel free to connect with me. I'm happy to talk in the future. Thanks.
Yeah.
One of those any friends of Duane kind of things.
That's right.
Duane, who else have you got for us in the future you want to bring? I'm surprised Gio's not on with us today.
Yeah, I'm talking to Gio actually in like right now, or I'm supposed to follow up. I'm supposed to have a call with him. Sean would be really great, just from like an insight into value analysis committees and hospitals and how they make decisions and sales cycle into a hospital. I think we just saw
that would be great. Do you happen to know Tally, the CEO at Pig Pug?
What's his name?
Okay, the answer is no. He was on our call today. And just as I figured out who he was, he jumped off the call because it was the top of the hour.
Okay.
And he is a working on a neurofeedback and AI-based drug-free brain training system for kids with ADHD and autism.
Wow.
I'd like to hear about that. That sounds very good.
I would love to hear about that. And I guarantee the biggest thing he's going to face is that the pharma company that makes Adderall is going to be a massive barrier because they have a thing called lobbyists, and that's a real thing. So that'll be the hardest thing. We're dealing with that with a client of ours who is in the anxiety world and does it with oh my gosh, what is this called?
Call me a client.
What's that?
I wouldn't call me a client yet.
No, VR. They use VR to treat that. And the lobbyists have posed issues with our classification within the FDA. For sure.
That's a really good market for direct to consumers. Direct to consumer is showing a very powerful segment with certain and against the lobbyists. They're really able to overcome what lobbyists and large companies aren't able to do. Treya, I can help you with your commercialization strategy for free. It's no problem. This is my field.
Yeah. So I think Sean would be good for another one, Joe. Just let us know when, and we'll get him on here. And then outside of that, Tim could probably contribute to that as well. You know, Tim and Sean are both pretty good in that.
I want to just share with you a marketing thought with you, unrelated to everything we've spoken about today. So I just found Vitaly, and I sent him an invitation to connect. I wrote, "Funny you jumped off today's call just as I looked you up. I was going to invite you on screen." He replied, "Hi, Joe, glad to be connected." I said, "We want you back. We're actually talking about you now." The point of me sharing this with you is, here's someone of influence. And he said, "Really? Yes, come back." And I made a connection because we had something in common, loose, but here we are. So a lot of times, you know, as you shared, Duane, and I talk about all the time, when you talk about ways to increase awareness and build your brand, it's word of mouth and it's outreach and it's personal, just like I did.
Yeah. Joe, I'll give you a plug for MDG Premium. Sanjeev is a client of ours as well at Hooray. And how that came about was I saw Sanjeev present whenever he did his MDG Premium. He said he was looking for investors. I made an introduction to SOSV, which also runs an accelerator called Hacks. They ended up investing in him and doing a lot of his product development. Sanjeev came back for a seed and Series A support. And now we're working with him on capital raise strategy and pitch deck and some of the stuff Rich will do as well for him. So yeah.
Great. I'm cutting you short only because Vitaly did come back. I just invited him to be a panelist, but he has a meeting that started 5 minutes ago. So maybe he'll accept the invitation, come on real quick and say hi, and we'll get him back.
Cool. I gotta run as well because I gotta keep Giovanni waiting here.
Okay,
yeah. All right. Good speaking with everyone.
If you're listening, we want you back. Find me on LinkedIn. We'll talk some more. And everybody, next week, Michelle Wu is going to do a demo, I think, with David. David will real time be like, I need to find some data. He's going to use her system and show us all how it works.
Sweet. Cool.
Okay. Thanks, everyone. Have a great week. Bye.